Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is June 11th, 2017 edition of Market Outlook. All right, so you had interesting action on Friday, and I would call that a changing of the guard. So the Russell 2000 that had been lagging and was basically flat on the year just not too long ago, like a couple of weeks ago, picked up some nice overall performance. It was up 1.24% over the last 5 trading days. Compare that to Nasdaq, which had been on fire and up over 20%, down 2.4%. So, this is what you call the classic changing of the guard. What's going to be interesting to see is if these once lagging indices over the last 6 months can pick up the enough momentum to power the overall markets higher still. Now, in terms of volume, the volume is also confirming the market action. So you've got 4 accumulation days over the last 2 weeks in the Dow, 4 accumulation days in the IWM, where you can see basically 3 accumulation and 3 distribution days in the Nasdaq 100 and the S&P. So the volume is definitely confirming the price action. So I give overall still sort of, it's almost a neutral to a slight positive at the moment, even though you're basically all in bullish phases. That sell-off on Friday and the nasty action in some of those leading NASDAQ stocks could definitely cause a crimp in the overall action in the market as well. But net, considering we did get 2 indices to close on all-time new highs while the leading indices sort of paused, I still give that an overall positive because the non-uniformity among all of the indices. Let's take a look at sectors. And the other thing that you can see that's quite obvious is a passing of the baton to the weaker sectors as well. So a couple of things. The financials, which up until about 2 weeks ago were actually down on the year, up 3.6%. So that's definitely a pickup and also in a bullish phase now. So as you can see, in terms of all of the sectors here, most of the sectors are in bullish phases and having decent performance for the year, with only retail and energy in trouble or in a negative zone. So net, even though the semiconductors down 3.8%, right, for the day on Friday, down 1% on the week. Same thing with technology, utilities. So the top 3 leaders here definitely losing ground, but still in pretty strong territory, and the baton being passed to the financials, which are quite interesting that's occurred. So the key thing is to make sure that what is now or what was leading for the week continues to be strong, because it looks like the memo that went out on Friday was enough's enough in the leading sectors. It's going to be a pause. So maybe it'll inch its way higher if the buying really persists and continues into that financial sector and the new leader. Okay, let's take a look at the next table, which is market hotspots. Also interesting to note, despite all of the potential negative energy news, oil and gas exploration actually very strong on Friday. 5-day change positive, definitely besting the S&P 500. So that's interesting to note. But net, the biggest theme overall is Eurozone stocks, Austria, Spain, Italy. These are the strongest performing assets across the board. And that is certainly interesting to note. The next chart I want to point out is the VIX. All the other market internal indicators, not really all that interesting at the moment. So what I want to point out is just exactly where we are in the VIX chart here, because we're at a very interesting overall level. And as you can see that once we drop down beneath the lows in here, we stayed below and we had this enormous pop in volatility. I mean, it went up, I don't know, almost 40% with this drop in here. And the early warning was we started to inch above on an intraday basis, above this basic about 11% level in VIX. So we're doing the same sort of pattern here. And if we move above just the recent highs on Friday, that could mean the market is in trouble. So overall, you've got the lows on Friday in the S&P at, where is it, 242 level, 241.95. That's important. What might give you a heads up early warning is a pop in volatility that would take out the absolute VIX reading just over 11. And so that is the key chart to watch. It definitely can act as a lead indicator here. We're not waiting necessarily now for the 50-day or the 200-day moving average to be taken out. We've got a possibility of using the shorter term charts, and in fact, just a move a little bit above current levels would make me concerned. On the other hand, we just may have rallied back up to the top of that resistance zone that's highlighted here, and then obviously moving back down again would put this market in rally mode. So one final chart that I like to take a look at is looking at value versus growth stocks. To me, this is the core theme here as we move into the Dow and the IWM leading and the pause and the sell-off in Nasdaq. Take a look. This is our triple play indicator, looking at the relationship between value, VTV, and growth. And as you can see, in mid to late December, we got a nice sell signal in value and move into growth. That has been on fire. And look, the memo must have been passed around on Friday. And look, we finally reversed basically a 6-month or a 5.5-month signal that was showing that growth stocks, right, like FANG, the Nasdaq 100, was going to outperform. And so now we've got a reversal of that signal, and it looks like we've got a changing of the guard overall in the market. It'll be interesting to, again, note, can value stocks carry the next leg of the market? Okay, that's it for now. Good luck with your trading, and see you next week.